I'm really happy to be here with Stani and Guy, two of the people really innovating and driving our industry forward to the next stage. Really excited to be in this great place. Thank you, Stani, for hosting such a cool and interesting thing here with such a great view.
Thanks for coming.
My pleasure. So I guess I'll just jump right into it. So I think the first thing that we're all wondering is, what is really driving the growth of the RWA industry, and how much of that growth is stables versus everything else that isn't a stable? So Stani, how do you think about that?
Yeah, I mean, stablecoins are kind of like the ultimate RWA in the same category, in the sense that you have some sort of value that is in the real world, that is tokenized and used on chain. Obviously, the big difference between stablecoins and the RWAs or these other off-chain assets that we're thinking about is that stablecoins, they don't distribute yield to the end users, and they're not seen as securities, as an example. But I do think that stablecoins being able to grow into the existing scale is quite substantial. And from DeFi perspective, stablecoins are the only way to access DeFi, to consume collateralized assets and consume liquidity, and at the same time to be able to extract yield opportunities. And I think that going forward, we're going to see more RWA assets that are actually interest yield generating, something that is more familiar to the traditional financial system. And these assets will eventually outgrow stablecoins, and potentially even native crypto assets. And that's why it's important when we build this technology, and I know there's a lot of builders here today, is we try to build in a way that the technology is agnostic to these assets. So it should apply to the more native crypto assets, stablecoins, and RWAs as well.
Yeah, I agree with that. I think if we just look at what is the largest tokenized asset that's sitting on chain right now, that's come out in the last 2 years, it's the BlackRock BUIDL fund, which launched around a year ago now. Ethena, I think, holds roughly 55 to 60% of that fund within the backing of USDTB, which is one of our products. And then if you add Sky or Maker to the equation there, roughly 90% of the entire fund is held by just two entities, and those are both dollar issuers. So I'd say that stablecoin issuers are actually the single most important drivers for RWA growth that we've seen in the last 18 months. But I think the more interesting question is thinking about what other assets are going to start to come into some of these hybrid issuers who can expand the scope of what type of assets sit within stablecoin adjacent products. Sky had some pretty interesting news last week where $1 billion CLO fund from Janus Henderson was actually put into the backing of DAI. And I think this is a trend that we're going to progressively see, which is all of the credit assets that exist between very simple, liquid, clean T-bills and then illiquid private credit. There's a whole universe of different assets that fit within there, and your ability to actually put them into stablecoins where they become more useful collateral to use throughout CeFi or DeFi is actually what I think is going to be the largest driver of demand going forward for these assets. So I think they're massively intertwined, and the growth of stablecoins is actually a massive beneficiary for the growth of RWAs going forward.
And I think we're going to go more towards, we have started with the lower side of the risk curve, and so you see a lot of T-bills, tokenized money market funds, and some of the people I talk in DeFi space find them very boring. And it is boring because these are kind of like the lowest risk factor of assets. But down the line, what is going to happen is that, what Guy mentioned, is that you're going to see more assets coming in and going up on the risk curve and going into different types of credit products where you have a yield between 6 to 7 to 9% as well down the line, and also volatility. So Robinhood recently announced the tokenized equities and private equity as well, and there's a lot of projects working on the same category. So we're going to see also more going further down the volatility curve. And I think that a lot of these assets actually don't have necessarily liquidity on chain. Doesn't really stop actually creating the financial opportunity on chain. So you can still use these assets collateralized on chain, have a better auditability, and at the same time create the opportunity for someone to liquidate these assets, repo the collateral, and then manage the actual reshuffling of these assets then off chain where there is liquidity. For example, ETFs, not private stocks, but public equities, and a lot of the debt instruments as well.
Yeah, I completely agree. I think the thing that I always think about when I think about stable coins is that they're called stable coins, not fiat coins, right? And so I think the initial thinking of stable coins was that they would be backed by, a more and more diverse set of assets. And I think we're starting to go into that direction, and that diversification of what's backing a stable coin in a more volatile view of traditional financial markets will make the stable concept of stable coins more and more valuable, and what they're backed by will get more and more seriously evaluated, right? And so if you have a more diversified stable coin, that'll have value, and that'll suck up and need demand for these other tokenized things that get put in the basket of the stable coin. For me though, the stable coin trend is great because you have high yield, and as long as the yield remains high, it'll work. But you also, I think, need something to buy in stable coins. So for me, there shouldn't just be this world of, hey, there's a stable coin and it's diversified, and so you can consider it stable and more reliable in some way, and it's sharing or not sharing yield with you, whatever it does there. But you actually need a market of things to buy with a stable coin. So the stable coins happening, I think, is now starting to get a little bit artificially driven by legislation allowing stable coins to be generated. And so everyone's going kind of little bonkers. And there's going to be a lot of these different stable coins. But at the end of the day, it's a payment method, right? It's a treasury holding method, and it's a payment method. And so you need to pay for something. And so I think what's next is, for the stable coins to go beyond whatever they're going through in this stage, is you have to be able to buy something with them that is useful. Or you have to be able to use them in some collateral management system that is better than the existing collateral management system. And the existing collateral management system in traditional finance is really whacked. It's like insane. They talk about things like 21.5. Our collateral management system works on 21.5. I'm like, okay, good for you. It's pretty nuts, right? Because you can't post collateral, you can't use collateral because of weekends, because of time differences. So I think it's going to be the yield on the treasuries, it's going to be the collateral management use case, but then it'll end up also having to be what you buy with the stable coins, right? And that's where I think there's still a lot of innovation and a lot of great stuff that can be generated. Why don't you folks tell us, what you're working on? Because there's so much going on with Aave and Ethena. It's hard to keep up the amount of innovation that you folks are putting out there. Like, unbelievable levels of innovation. So what is going on with Aave v4 and Horizon Market? How is that all developing?
Yeah, I think a lot. So I feel like we've been now building 7 or 8 years in DeFi, in very early days of when we saw like first decentralized exchanges like EtherDelta coming in and getting kind of like inspired as well to build credit on chain and collateralization. And up to this road, Aave has grown significantly to be the most trusted lending protocol in DeFi. And what we see is that over time, it's been a cumulative innovation so far. So a couple of years back, I sit down with our SVP of engineering, Emilio Frangella, who we were thinking about what could actually a next generation of Aave could look like. And one of the kind of like goals was focus on building the resiliency that Aave so far has been able to prove, but also down the line how we actually prepare a protocol, not just servicing the crypto native assets, but being agnostic to any type of use cases. And one of the amazing things about DeFi and this community is that the innovation happens everywhere. And what I mean by that is that there's a lot of builders here today and overall in our space that are constantly thinking what kind of interesting financial products to build on chain. And from our perspective is that we from the Aave Labs and overall are thinking that how do we empower all this innovation. So we reconstructed the architecture of Aave in V4 to be a combination of liquidity hubs and so-called spokes. And the idea there is that with liquidity hubs, we can create different types of risk profiles for users to actually choose and position themselves on the risk curve. But with these spokes that are attached to liquidity hubs, we can create different types of borrowing strategies. So what this means is that you can create a completely new market in Aave and add types of collaterals that weren't able to exist before. Tokenized assets that are, for example, NFTs, figuring out liquidity shares as a collateral, and different types of interesting use cases in a way where we don't really break the core principle of why Aave has been so successful is being able to concentrate the liquidity really well within the markets, while at the same time being able to profile risk depending on these collateral compositions. So the liquidity hubs actually act as, in some ways, I don't know if I can even say this, and our legal team probably will not be happy, but act as central banks, and then the spokes act in certain way as commercial banks. So the liquidity hub simply gives credit lines to the spokes that can be created by anyone, and if there's interesting innovation, you can request access to the Aave's deep liquidity. And this is really fundamentally important. Why? Because typically when, and a lot of DeFi founders really resonate this, that when you innovate something really cool and interesting, you have the problem of getting liquidity and that chicken and egg issue. And typically how this is resolved in our space is with incentives or going and renting out liquidity that actually goes away once the periods of this lease ends, essentially. So whatever you innovate, and if that innovation is interesting enough, you can get a credit line and access to deep liquidity and innovate. So that's a really important part of it. And while retaining the capital efficiency that we have within the Aave protocol. And besides V4, we're working on the Horizon initiative, which is specifically targeting to permissioned assets. So Horizon market will have permissioned RWAs as a collateral, and you can borrow permissionless stablecoins. So it's a kind of a hybrid market that is targeting assets that are liquid, but they're not liquid on chain, they're liquid off chain. And hopefully the liquidity will transition over time to on-chain. And that Horizon market will start as a Aave v3 market, and later will convert into a V4 spoke.
Yeah, Aave v4 is definitely very exciting and super innovative. And I think the institutional connection with Horizon markets is a very smart path for that institutional capital to flow in. So it makes a lot of great sense on many levels. Absolutely. Guy, what has your experience been like working with the institutional capital, which I think Ethena has a lot of experience working with, and how has that resulted in IUSD, and what is IUSD and how is that evolving?
Yeah, sure. So I guess the genesis behind us trying to think about the institutional product and why we needed it, I think, came from a little bit of a frustration, I think, in terms of where DeFi had evolved versus last cycle. I think if we just take a big step back and think about the flows within crypto at a macro level, you've really only seen inflows into BTC ETFs, inflows into stablecoins, but actually DeFi TVL as a total is kind of 30-40% off of the peak of where it was in 2021, except for Stani, who's still breaking all-time highs on TVL. But to me, that was actually just a strong indication that we've done a not-so-great job of actually getting this incredible tailwind that's coming into the space now, which is institutional investors are actually here and trying to deploy capital into our products, but actually delivering it in a format that actually makes sense for them where they can engage in a meaningful way. So I think the view that we had was a dollar with a yield is one of those products that makes sense for TradFi. You kind of look at, fixed income markets are 100 trillion plus in size. And one of the unique things that you can actually deliver from crypto is uncorrelated sources of return, which might have an excess return versus what they can achieve within TradFi. And so we're a bit more focused. I think the RWA trend is one that's interesting, and it's going to be one of the most important, I think, in the next few years. But the thing that excites us a bit more is thinking, what are unique crypto primitives that TradFi people can't access themselves, but need to come to crypto to actually get access to? And I think that's where you can actually capture more value and more alpha as a protocol, which is delivering something that they can't find themselves. So all of these RWA assets that we sort of described here, TradFi investors can access that themselves without ever coming on chain. It's more of a distribution channel for them to access crypto people via those channels. And so, the USDE product is essentially just trying to put a regulated wrapper around USDE to actually offer it more as like an investment product where asset managers, credit funds, hedge funds can essentially just put an SPV structure and take in money from any of their LPs and just get exposure to USDE at the underlying level. So that's just the way that we're trying to deliver things in a format that they can digest. And we just think the opportunity for delivering a dollar with a yield to TradFi is not like a $1 or $5 billion opportunity. It's like 100 billion plus, and it's just on us to execute on that. So.
And the interesting part, what Guy is kind of like explaining here, is the customization. So all these DeFi primitives that has been built as a technology can be customized to various different use cases. So in the DeFi Degen use case, you are using these permissionless markets and permissionless liquidity, and at the same time, you can use the same technology actually for permissioned requirements and tailor them specifically the requirements of different institutions. And I really like the kind of like an idea of making the institutional like attraction into two-way relationship where there's institutions looking into what could be the actual use case for a lot of these tokenized assets, because tokenization itself doesn't really do anything. It's just a tooling for, it's a technical tooling for bringing the assets on chain. But then the bigger question is that what is the actual utility for a lot of these RWAs? And the same way around. So being able to actually have better collateral management is a really big value proposition. And I think that's what really can drive a lot of the traction, especially because once you're able to use something like Aave, fully manage your positions, collateralize not just RWAs, let's say, like debt, but also equities and private debt, that type of an offering becomes quite robust for not just like the collateralization aspect, but building just better financial products. And I think that's what on-chain can actually do. And then the risk management aspect is really important for the institutional perspective. And I think DeFi is really well positioned. The fact that we are transparent and you can audit the whole risk in a systematic way, end to end, in the whole DeFi ecosystem is a really big value proposition compared to auditing, for example, financial statements on quarterly basis or annual basis, as an example. And in Aave v4, actually, it's really interesting where you can, as a user, we solve like very interesting problems compared to the previous version. So, for example, there is this interesting arbitrage loop where users are buying USDE, putting it as a collateral, and borrowing to get maximized return on that position. And typically, this position has been listed in the main core Aave market, but in the future, this can be a separate, separate liquidity hub with enhanced yield opportunity and a spoke. And the same spoke can even be connected to the main liquidity hub that can actually give a specific credit line for the users. So the main kind of like consumption behavior of Aave can still enjoy that slightly higher, let's say, risk-adjusted rate. But if you want to get fully into fully ape into that market, you can actually do that and select and position yourself in that risk curve. And that flexibility is really important, not just in these permissionless and DeFi assets, but also in RWAs as well. Because once you start moving alongside the risk curve, you should be able to ensure that you don't segregate liquidity, but still give the opportunity for choosing what kind of risk you want to take as a user.
Yeah, absolutely agree. I think there is a dimension of this where you make innovative financial products for institutions that they can't access in the traditional world. I think once you have that and you add in the risk management, I think the risk management of our industry is not currently viewed as superior because they don't understand it, right? They haven't taken enough time to fully evaluate how they can understand the underlying technical risk, counterparty risk, solvency, the various smart contract guarantees. But I absolutely agree with you that if our industry is able to create the type of highly innovative products like what Guy described, then they're able to reliably get yield on that and kind of put it in a system where the risk management is kind of meeting or surpassing their standards, then I absolutely see more institutional capital coming in. And then what the institutional capital I think will do is it'll allow even more liquidity and even more kind of high quality products to be generated that the DeFi community also benefits from. Because at the end of the day, it's the liquidity that we all really want. And institutions bringing that in, I think, will be a very big deal.
And we kind of have new types of challenges when it comes to off-chain assets. Because in on-chain, you can, if an asset is on an on-chain asset, you can verify the liquidity. But when it comes to off-chain assets, you have to basically think about new types of tooling and use things like, for example, proof of reserves that Chainlink is, for example, building as a tooling. And I think Ethena is using as well proof of reserves.
Yeah, I think it was actually a big piece for us because if anyone remembers when we first came out, I think there's a huge amount of skepticism, mistrust around the whole design because we had collateral and a lot of exposure to centralized exchanges. And I think a key piece for us was trying to get to actually a better level of transparency than you could find with something like a Circle or a Tether. And the way we did that was creating an internal proof of reserves where anyone can basically come in and actually just run a piece of software. And Chainlink's obviously one of the key partners that we have over there. And that actually gives you daily proof of reserves for the collateral backing that's sitting behind everything that we do. So I think it's a pretty cool feature that you can have a daily reconciliation to something that's connected to 3 different custodians, 6 different exchanges, all sitting off chain with like hundreds of different positions, all sort of verified by independent third parties on a daily basis. Yeah.
Yeah, absolutely. I think proof of reserves is kind of just the beginning. It's a very basic kind of functionality to prove the solvency of the asset, and it's really great. And it's you folks are very far ahead in using it, but I think very far beyond that, it'll go to what we have called proof of composition, which doesn't just show that something is there, but what that is in more detail. There will be things like proof of solvency, which we're also working on. And then you'll have a whole bunch of other proofs around the reliability of a cross-chain connection and proving that, if somebody cross-chains the token somewhere, it can be done in a secure way. That is going to require, greater security and levels of proof than I see in many places. You're going to need proofs about compliance. And so if you put proof about compliance in there, you can make compliance very efficient. And you can actually make the efficiency of compliance a kind of a next level feature because it reduces the friction. So I think the folks that have adopted proof of reserves are definitely on the cutting edge of what's there today. And I think it makes their products better today. And I think it's the right move because it shows more info and it guarantees things about the product that other competing products don't guarantee. But there's just so much more than that, right? There's so many more pieces of proof that can be put on chain. There's so many more pieces of identity data, cross-chain connectivity proofs to prove that the bridge is actually reliable and that whatever you got minted on the other end is not at risk. So I think there's like a whole new level of proving all this stuff that institutions are going to find critical, which is kind of what Chainlink is built to do, is to provide all those proofs in a highly reliable way, both for the DeFi community and increasingly so that the institutional capital is positive and comfortable putting their money into these systems. So I think we're all on the same page about how important that is. So how are you seeing, the institutional progress into the RWA industry and sector and the DeFi sector? So how are institutions entering our industry at this point from what you're seeing? Stani, please.
I mean, it's very, obviously it's slow. I mean, DeFi itself was growing quite slowly in the beginning, and and reason for that is it's definitely a new space, and I think what institutions are also doing is that they're not really rushing to tokenize everything that they have, right? So they need to, first of all, understand the technology that many of institutions already do, and service providers to help on this process. But also, what they need to always find out is what is the actual use case. So what is the value of bringing an asset on chain, and what kind of benefits that can actually have. And I think this latter part is really important to get it right, because it won't be really beneficial of having a bunch of assets on chain that no one is really actually going to use. So being able to bring something really usable, I think private equity has been a really great example, because there's a lot of lack of access at the moment to the companies that are building the future, such as, for example, Stripe or SpaceX or so. And at the same time, also private debt, which is typically backing infrastructure, backing real estate, backing also private equity companies at the same time. So I think we're still very early phase where we're at the lower side of the risk curve and seeing kind of low-hanging fruits of tokenizations of treasuries, treasury bills, tokenizations of money market funds. But once we start to actually move down the volatility curve and up on the risk curve, I think that's where things become more interesting for at least our audience. And then as we start seeing more and more assets that are very usable, we start to seeing different types of DeFi strategies and DeFi utilization of these assets. And I think that's where DeFi becomes important, because you have to have some sort of fundamental utility. And for me, it's collateralization, the fact that you can use assets more effectively, use your portfolio more and holdings more effectively, is really fundamentally big use case for RWAs.
Yeah, I think we sort of think about it in two different directions. So you've got institutions coming in trying to sell their products to crypto users, platforms, and basically distribute into our ecosystem. And then the flip side of that is, what are the products that we're actually taking and exporting out in the opposite direction, which actually brings inflows into crypto. And I think the interesting position that both Aave and Ethena sit in is that we're actually sort of playing both functions at once for those players. So to the extent that we can be helping those people distribute their products into places where they just don't have the DNA or nuance to understand how to do that effectively, we can be helpful in some sort of taking that to DeFi platforms or even centralized exchanges. But I think the more interesting opportunity, which is what we touched on earlier, which is the pools of capital that just sit within TradFi, with much lower cost of capital than you find within DeFi, is just a very interesting distribution channel for us and our products to go and attack. So yeah, I sort of see it flowing in two different directions, but the latter is actually a much more meaningful impact, I think, on crypto, which is how do you actually get more liquidity and inflows into our system rather than distributing the products that they have to our users. In terms of like what's next, what are the products that we think are exciting? I think I touched on it earlier, but that sort of thought process of a credit spectrum between extremely liquid T-bills that exist on chain now, and then something like the Apollo ACRED vehicle, which is like 90-day liquidity with a bit more yield. I think there's just an incredibly interesting credit universe that sits between those two bookends, which would find very interesting use cases, whether it's in leverage money markets, centralized exchange, trading collateral. And if we just take a step back and think about, what is 80% of finance in the real world? It's all debt capital markets based. It's much less to do with equities. And there's just this enormous universe of different types of assets that still need to come on chain. And all of the cool financial engineering that we find around the small universe of assets that we deal with right now can expand into all of those pieces. And I think the moment that becomes most interesting is actually when the rate cycle starts to turn. and T-bills just become less interesting as an asset. No one was talking about this in 2020, by the way. How do we bring T-bills on chain?
Right.
It became an interesting question in 22 when it was at
Right.
5% and DeFi yields collapsed. And I think
Yeah.
we'll start to see the same thing again. Whenever that rate cycle turns and T-bills are 3 or 2%, I just don't think that that's a return threshold that excites people. And
Yeah.
we're going to have to start to look at what else is there along the credit spectrum.
Yeah, we absolutely have to go beyond T-bills, even for that reason, and just because the industry has to be about more than that. I think all the products you folks have described are great, and I think they're attractive to the institutional user. I think the interaction between IUSD and Horizon is also great, and how those two things can work together, and how everything you just said with these innovative products, and then those innovative products working in the Horizon kind of markets construct, and I think it's really super compatible. I wish we had more time to go into it. I'm getting the signal that we have to wrap up. But as always, it's been a fascinating conversation, with two of the smartest people that I know in this whole industry. And just want to thank you folks for continuing to push the envelope on the permissionless innovation that our industry is so well known for and so well regarded for. When I think about permissionless innovation, I really think of these two people here that are kind of really pushing the limits of what our industry is doing. So thank you for all the great work. Thank you.
Thanks for having us.
Thank you. Thank you, Aaron.
Fantastic, fantastic discussion.